Hey, welcome back into the podcast. Today we're talking specifically to sellers. If you are a seller out there and trying to sell your house in this market, things have changed and we are trying to give you an edge on your competition. So once again, my name is Ken Angst, team leader of the Angst Real Estate Team. Our podcast is very simple. We are trying to help people buy, sell, and invest in real estate in Northern Nevada. And that's what our podcast is all about. So if you want to know more information about us, check us out on our website, livinginsouth.reno.com, and let us know if you have any comments. So today we have a special guest. She hasn't been in a while. Happy New Year.
Right.
It's Elena Bolin with Wholesale Mortgage.
Yes.
How are you doing?
Great, and I can't believe it's already a new year.
I know, it's not even New Year anymore. We're
Right.
coming up on April here,
Yeah.
so we're coming up on 4 months gone.
Yes.
And it's incredible.
Quickly.
Things are changing. So what we're going to do today is, if you're a seller, we're going to reintroduce you to several concepts that buyers are looking at. And in return, if you're knowledgeable about the buyer coming in to buy your house, it can make your house and your sale go more smoother and make you stand out in your competition.
Yeah.
So,
right.
All right, so first things, in the past 2 or 5 years, nobody needed to accept or consider a VA or FHA loan. But those have changed. Those are back and with higher rates. So what we're going to do is talk about those specifics and educate you a little bit about that. And if you're a buyer, this is very relevant to you. So we're going to do a little refresher course. So let's first talk about VA. What is a VA loan? Give us some specifics on what the program is out there. So.
Right. So the VA loan was put into place by the government as a benefit to veterans or active duty military.
And I want to say up front, this is a good program.
It is.
And even if, veterans, we got to celebrate our veterans and give them, a better chance to get into a house. So.
Right. And, it has some different caveats than conventional loans do. So in past years, primarily due to miseducation, VA loans were not widely accepted in our Northern Nevada market. But if you have the right lender who knows what they're doing and you make sure that they've got all their ducks in a row, it's a great loan and a good benefit that veterans and active duty military should be able to take advantage of. And it gives them more buying power as a buyer as well.
Right.
They're a great loan product.
So give us a little bit about, a little information about what a VA loan is, the funding fee, how much you need to put down so that people know what's going on now.
Right. So the VA loan does not require a down payment in most cases. Veterans can have multiple VA loans, and as you come down the line with your second and third VA loan, it can become more likely that you'll need a down payment. But for most of our VA loans that we see in our area, no down payment required.
Okay.
This is nice because, if you've got a situation where, maybe things are a little tight for the seller, you're not going to worry too much about having what we used to call appraisal gaps and things like that, because if the veteran's able to borrow 100% of the sales price and they've got a little money on the side, they don't need it for a down payment. It can help make up for any gaps that might be in place for negotiations and things like that.
Okay, well now what's a VA funding fee, or is that the correct term?
Yeah, that's perfect. Yes. Unless a veteran is 10% disabled or more, they are charged a VA funding fee. The percentage of the fee is different for each veteran depending on a couple of items like if they have used the loan before, etc. It's on average about 3% of the loan, so it's a big number.
Wow.
However, the veteran does get to finance the fee.
Okay.
So if, just for the sake of a round number,
500,000.
if they're buying for $500,000, and then you'll see a loan amount of $515 because they get to finance that fee.
And that doesn't impact the appraisal, right?
It does not.
Okay.
No.
So, a few things. If you're a seller, you get a contract in, zero down, kind of a loan that you haven't seen before. So don't, make sure that you're looking into it and your realtor out there knows about it so that you can make a good determination if an offer comes in. Because they are good loans. Usually, most of the time, they're very well qualified people.
Right.
It's just a benefit that has been shunned away by sellers in previous years, but you can help someone out, and it can be a really good person to buy your house.
Right. Another thing to consider with the VA loan as well, if we're entering a market where we're worried about a recession, a veteran buyer is not going to get laid off. It's not going to happen. And if they're, retired, that income is not going to go away. So it's really great in that way. There's always more, misnomers about the VA loan as well.
Yep.
Like fees that the seller has to pay. There are no fees that a seller has to pay on
It's
the
a
VA
lot different
loan.
on the contract now, so that's good, because they used to have to pay for the pest inspection, what else? There was a $200 weird fee that you had to,
Yeah, there's a couple small fees.
but those are gone now.
But those are gone, and the only time sellers have to step in to pay any fees is if the lender charges a 1% origination fee. If there's no origination fee, which most lenders don't charge to veterans, then you don't have to worry about any seller paid costs.
Okay, so as a seller, please consider VA loans.
Right.
Are they assumable? We'll talk about this in a second with the FHA, but are they assumable?
They are.
But most of the time you want it to be assumed by a veteran, or if
Yes.
you're okay, so look into that. We'll talk about that in a second. So they are assumable, so we'll talk about the importance of that as a seller too in a second. All right, so we're going to transition into the next type of loan that's out there, government backed. FHA, what does it stand for, and what is the minimum down payment, and how's it different than a traditional mortgage or a VA?
Federal Housing Administration, that's our acronym for FHA. You hear lots of acronyms in real estate, it can get exhausting. So just know that the FHA loan is another government-backed loan, and another positive for buyers that primarily would not be able to get their hands on a conventional loan for reasons like work history, credit history, or sometimes you'll see buyers need an FHA loan because they have changed jobs a couple of times.
Yep.
They still have the job history. The job history is great, but it's a good backup for someone that's just changed careers entirely, which we have seen a lot, especially post-COVID. Some people just completely went, from being a teacher to tech.
Right.
And the FHA loan gives them an opportunity to still get in and become a buyer that way.
Now what about down payment?
3.5% down.
Okay.
Which is super reasonable. When you look at that, even compared to 5% down options for conventional, it really does, help them again with another little hand up there. Another big change that has recently occurred.
Yeah, you gotta pay attention to this one, especially if you're a buyer.
Yeah,
this
is really big. Right now, the monthly FHA mortgage insurance fee is 0.85%, which for our medium purchase price comes out to about $300 a month. This is going to take it down to about $142 a month, which is huge. That can give you up to $25,000 more in buying power, or you just take the lower monthly payment.
So if you're a buyer out there, and when does this take place?
April.
So you're gonna have, so get in, talk to your lender, because it's gonna drop your mortgage insurance. Now, what is mortgage insurance, and why do they charge it? And how do you eventually get that off? Those are questions we get a lot.
Yeah, that's a really good question. FHA mortgage insurance is there as a fee. It doesn't ever go to help reduce the amount that you owe, and it doesn't actually insure you as a buyer. It insures whatever bank lends you the money. And what happens with that money is it's collected into a big pot, and it's there to cover any losses that have been backed by the government. So if you as a buyer have an FHA loan and your house forecloses, it's not a loss from that bank. The government comes in and backs that bank and reimburses them for the loss with that big pot of money that's paid in by all FHA buyers every month.
And a lot of questions we get is it's every month for the life of the loan, unless what? Can you get rid of it? Do you have to refinance? What are the new rules on that, or what are the rules?
95% of the time, you just need to plan on refinancing to get rid of the FHA mortgage insurance. It's pretty rare. It's 1 out of a 20,000 odd that you would have the loan type that would allow you to get rid of FHA mortgage without the refinance. So the big caveat with that is, do you want to plan on refinancing to remove it? Yes. However, just stay comfortable with that payment and make sure that you're not outside of your comfort zone, because you never want to guarantee a refinance. It's just not always a possibility.
Not in this market.
It's a hope, and it's very likely, but you just never want to bank on that.
So good. Good information on that. Now, can an FHA loan, can they put 5% down, or is that moving into conventional, or what? Do you have to put 3.5% down to be an FHA, or can you put more or less, or?
I've had, get ready for this, FHA buyers put 20% down.
Now, does that get rid of
No.
their no? But does it lessen your mortgage insurance?
Yeah.
When the more you put down, the less your mortgage insurance is.
Yeah, exactly.
Now, why would you do that? Why wouldn't you just go
If
conventional?
you've had a credit challenge,
Okay.
if you have a for example, if someone had a bankruptcy 2 years ago, you can get an FHA loan on the anniversary of the second year and get right in there, use that FHA loan. You can't do it for conventional for 4 years. So again, giving another buyer a hand up and to get into own a home.
Yep, great. All right, so while we're on that, what is the FHA? They have new limits out for 2023.
Yes.
When do they go into play, and what is the amount that an FHA buyer can purchase in Washoe County?
You can plan on spending about $555,000 as an FHA buyer in Washoe County, which is a pretty healthy budget.
Yep.
The maximum loan amount that you can hit for an FHA buyer is $537,750. Pretty.
Wow, it's up quite a bit.
Yes,
and
pretty
now
fair.
The price is down from $615. We're down to $515-ish.
Yeah, so it's
can
great.
get a median home price now.
Yeah.
And that was not always the case.
No, for the last 2 years, I would say that was not achievable. So this is really good, positive news for buyers. And if you're a seller, it's a good thing too, because you know that you've got a wider pool of buyers if you're open to FHA.
And
offers.
you should. I mean, obviously you got to analyze it.
Right.
Call the lender. As a seller, we're gonna always talk to the lender before we accept an offer.
Yes.
But so that's great.
Yep.
So take a look at that. That's another way that we haven't, for several years.
Yeah.
FHA's kind of been on the bottom, but with less buyers because of higher interest rates, and it increases the pool of people who can purchase home.
Yeah, which is a positive.
All right, so we know the new limits. Now, if you're a seller and you're out there and you have an FHA or a VA loan, it's called what's potentially your mortgage is assumable.
Yes.
Which, if you have a low interest rate, that could be good for a potential buyer and make your house more competitive to sell. So first things first, what is an assumable mortgage? Are all FHA, VA loans assumable? And then we'll get to the questions on like interest rates and all that. So
Yes. So yes, if you have an FHA loan, if you have a VA loan, it is assumable. Now the caveat is, who is your servicer? There is a plethora of servicers out on the market, because if you have ever had a mortgage for an extended period of time, you'll notice that your servicing can be sold, which means you might start out with Bank A, Bank B is your new servicer, and they will have different rules than your original lender. Now they can never change the term of your loan, but they can change the rules that they operate on in regards to loan assumptions. So that means that some servicers will take 60 days to have a loan assumption completed. Some will take 12 months. So that's a big deal to research.
So how do you research that? I mean, we have a new listing coming. They have an FHA loan that they got 3 years ago, 3%. What's the best way to find this out? Because obviously you want to find this out before you list your house if possible.
Right.
And find out the details. You call the servicer, or what's the best way to do that?
Yes, contact your servicer if you can before you list, so that you have that leg up in knowing that you're putting your best foot forward in the way to market your home as a seller. That way you've got the information for anybody that is interested in looking at that loan assumption. Now the downfall for you as a seller is that
what are the pitfalls? You
have to wait for your servicer to get all these things done before you can get your money and move on with your life. That can be tough because as a seller, you're usually doing this to move, right? So it really stalls things for you. But one thing you can do is you can accept backup offers while you are waiting for that assumption to go through. Of course, the assumption is no longer on the table for any new buyers, but on your behalf. But it's just still something that's good to help you stand out and really help that new buyer coming into play, because if they can take advantage of your rate from 3 years ago, that's going to be huge for them.
All right, so if you have a buyer come in and says, wow, you said in the remarks that your house is assumable, what's the process? And let's just say that you wholesale mortgage. Do you guys service mortgages?
We do not.
Okay,
no.
but let's just say that if you are the bank, is it just like a regular, at that time they come in, the new buyer contacts your bank and they go through the process?
Yes, but the steps for it are more to jump through, just because there's more tiers of clearance to get through to make sure that this is all going to work out. And as you can imagine, that's not the bank's priority. right?
Right.
So you're never going to be first in line in that way. And you have to also make sure, it can get exciting when you talk about the assumption for your buyer and for yourself as the seller. But you have to make sure that that buyer has enough money to make up the difference between what you owe and what they're going to pay for your property.
Yeah, so that's why we have Ren. That's a good point. So let's just say they bought it in 2017 for $300,000. It's worth $500,000.
Right.
And then they bought it down. They paid down. So let's just say that's $250,000. So someone's going to have to bring in. That's a tough hurdle, right?
Yes.
A lot of people are going to.
Right. But for some people, that's an achievable thing, especially if they themselves have sold a home. So you've got a couple transactions within the works, and you know how sometimes as you go down the ladder, it affects several families. So you just got to make sure everybody's on board for that wait time and do your research up front with your servicer.
And then, so how is the contract structured that you see? So I'm saying that it's 60 days, or does the seller ask the processor that's processing the loan, how long does it take for this? And then that's the number that you want on the contract?
Yeah. And the problem is that if the servicer exceeds that time frame, everybody can cancel. So you got to make sure that you are very cautious with the time frame that you put on that contract, and just make sure everybody's on board for an extension if it should come up, and you can never guarantee that.
Right. So that's a good way to get someone in your house. They have to make up the difference, but they get a nice rate.
Yes, huge.
3% versus what? 7.25%, 7.5%?
Yes.
So that's something that someone might be able to work out. Now, what are the challenges with a VA assumable mortgage? Because rumor has it, correct me if I'm wrong, is that if it's not a veteran that assumes your mortgage as a veteran, then you lose your benefit, VA benefit. Is that true, or what is that?
Your eligibility is tied up until that buyer does something with that mortgage. They refinance it into conventional, or they sell. And a lot of veterans don't realize that, or it's not explained to them properly during the loan assumption process. Now, if another veteran comes in and assumes your loan, you can replace the entitlement with your own. But if it's a non-veteran buyer, you have to really understand that it can sit there, and it can be a decade.
Or more.
Yeah, or
20
more.
years,
right.
Whatever.
And a lot of times veterans do have bonus entitlement. So if they move on, there's still the possibility of putting no down payment into place again. But again, research is your friend here, and you have to make sure that all that is into play in regards to where you're going to move and what your new purchase price would be.
Yeah, because if you don't want to lose your benefit, because then you don't get it on the next home.
Right.
So keep that in mind. So good information could make you, if you're a seller, your house more competitive if you have all your ducks in a row.
Yeah.
So that's where, particularly when it's snowing and raining here in Nevada, not that it's done that a lot, this is the time to be doing this in the next 2 to 3 months, and have this so that maybe when April's over, or May, you're ready to go. Yep. But look into it and find out the information. So, okay, last tip. I always put the best one at the end. What is the secret lender tip? What's going on? What are rates right now? And what do you see working for buyers out there right now and sellers? I mean, how are we getting deals done?
Right. Well, the positive right now with our market is that it's easier for buyers to get their foot in the door because the affordability factor wasn't there. But the challenge is the interest rate. Yep. So you've got to come up with a solution for that interest rate. And if you, as the seller and the buyer, come together to figure out how to buy down that buyer's interest rate, and you can settle on or negotiate what's called a buy down credit.
A 2-to-1 buy down?
Yeah.
Is there 3-to-1, or what's the deal?
There's 3-2-1, there's 2-1, and
what does
there's
it mean?
permanent.
So this is good, because this is where, if you have a skilled realtor on both sides, you can negotiate something that benefits both parties and get a deal done that would not get done ordinarily. So I'm just going to stick with the 2-to-1 rate buy down. I see a lot with home builders, but what does that mean for a seller, and what kind of costs are associated with it?
So typically the seller pays that entire fee. So the seller will pay 2 to 3 points, and not every lender is going to be the same, but they'll pay 2 to 3 points, which means we'll stick with $500,000. So that means that seller is going to pay $10,000 to $15,000 to buy down temporarily that buyer's interest rate. So year one, that buyer is going to have a 2% less than the market interest rate. So if we're at 6 today, then that buyer is going to have a 4% rate on year 1. Year 2, it's going to start to tack up, and it's going to go back up to 5, and then year 3, it's going to go back
and
up to that
basically
6.
what the seller's doing is paying the interest, right, in year
Right.
1 and year 2.
Mm-hmm.
Essentially, that's what the fee is.
Yes, exactly.
And then it reverts right back to, and that doesn't impact any mortgage insurance or anything, right?
Nope.
It's so okay. So it's almost like what's the right? Like adjustable arm almost.
Yes, that's my favorite comparison to that, because really your rate is adjusting. You have to know that as a buyer. The nice thing is that you know where it's going to adjust to and where it will stay. It's not going to continually adjust every year, every 6 months, every 5 years. So as a buyer, that's nice to have that guarantee.
Put the money aside.
Yeah.
So you have it for next year, and you get 2 year or 3 year.
Yes.
Is there a limit?
Yes, 3 is the limit.
3 is the limit.
Mhm.
So maybe negotiate a 3.
Mhm.
Maybe the buyer brings in for some and do a negotiation. That's and these little tips are the difference here between getting your house sold and not. So if you have to move, and we talked about this off camera here, sellers need to be ready to negotiate a little bit.
Yeah.
And it's not always just lower the price.
Mm-hmm.
Lower the price is not necessarily what people need.
No.
And that's where you got to have a realtor and a lender involved.
Mm-hmm.
And probably another realtor on the other side that knows what's going on, so that you can negotiate, and it's a win-win. So.
Right.
All right.
Okay.
Great coming
Thank
in.
you.
She's going to come back. We're going to do another video on downsizing. So if you're tired of shoveling your driveway or your roof, and you're paying all those utilities, you're going to want to check out the next video that we have coming out. But thanks for coming in. It's always good to see you, and we'll talk to you soon.
Glad
Thanks.
to help. Thank you.
Take care.